I'm going to show you a system that is the best mathematical way to create predictable wealth. Now, this isn't crypto, this isn't penny stocks, this isn't any kind of high risk assets. In fact, it's exactly the opposite. One of the things that I believe is that we should all be focused on financial structure and not chasing massive returns. One of the greatest lies that we're taught is the younger we are, the more risk we can take, when in fact, the younger we are, the less risk we have to take to achieve our desired financial objectives. What I'm going to show you in this video is that simply by focusing on financial efficiency and building in some rules that you live your life by, you can accomplish all the things that you want in your life quicker without changing your lifestyle if you're willing to do a couple little things first. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today we are talking about the most predictable way to build wealth. Now, you probably, if you've gone on YouTube or TikTok or Instagram, you've probably seen a lot of people talking about how you can make all the money back that you spend on your cars, and you can actually make money buying cars. Now, I'm not going to go there. I don't believe that is the case personally, but what I do want to show you is a financial system that you can implement in your life to create predictable results. One of the things I believe to be true is that if we just focus on financial efficiency, then we can achieve everything we want with less risk in a shorter time frame. And what I'm going to do in this video is I'm going to go through a process that helps break down a couple different mindsets and a couple different kind of personalities around money. And typically what we see out of, I would say 95% of people fall into this categorization, one of these two categorizations. And then I'm going to show you how you can take a blend of those two people and you can create predictable wealth and create a financial system that's going to help you get where you want to go on a more predictable basis. So that said, let's go over to the board here and get into it. So this is what I would call the average American. So what does this mean? You'll notice here I've got green lines and I have red lines. The green lines are representative of saving money, and the red lines are representative of spending money. So as you go through the green years, you're saving right here, and then you spend. So let's just say that we have $30,000 or $50,000 at the top end of the line. Like this top level here is worth 50,000 bucks right up here. You save up, you get $50,000. Now we're going to use this as an example, purchasing a car, right? Now, the intent of this video is not to show you how you can get your money back on a car. I'm using the car because pretty much everyone needs to buy one, right? This is applicable to everybody. That's why this principle, this concept absolutely is universal and across the board. And what we see here is that what people are doing is, this is what I would call a saver. A saver is somebody who will go out and they'll save money. They delay gratification. They save up $10,000. Let's just use a gold pen here, and I'll use this as an example, right? So they save $10,000 here. They go through the year, save another 10,000, save another 10,000, 30, 40, finally 50,000 they get to. Now, maybe they were saving up this $50,000 because they wanted to buy a nice new car. And so then when they save that $50,000, they spend the cash on that money. Now, there's a little thing people don't realize is they think, all right, what's the best way to buy cars? The best way to buy a car, purchasing it, or is it to finance it? And the answer is, well, it depends on who you talk to and what they're going to give you an answer. Dave Ramsey will tell you, never finance a depreciating asset, which a car is absolutely a depreciating asset. And so from that lens, he would say always save up the cash, right? And then, get to this 50 grand and then spend the money down. And then when you have a car, then, let's say you have your 50K car. Now you have a car, but what do you not have? You don't have your 50 grand, right? So you got to save up again, because at the end of the day, cars last about 5 years if you want to have like a good, decent quality car. And I would say that's something to strive for, having a good, consistent quality car that, after 5 years and after you put a certain amount of mileage on it, it starts racking up bills and it starts racking up repairs and stuff of that nature. And you want something dependable for your family and all these different things. So, and we're talking about this day and age, $50,000 car isn't even that crazy as far as quality goes, right? And so what you have is you have your car, you lose your $50,000, and here's the deal. What you do is because you lose this $50,000, you have to think about what's the opportunity cost on this $50,000, right? That's something to consider. Now, granted, here's the bottom line. Let's face it. We live in America. Most people are not doing this. Most people are not saving up $50,000, delaying gratification, driving a jalopy for the first 5 years as they're saving $10,000 per year right here, right? And driving a beater car until they have the $50,000 and delay gratification, buy that $50,000 car and have it. They're just going out and they're financing it. But for the sake of this, there are some people that do this, right? There are some people that go out and they save money, and you have 1 car, 2 cars, 3 cars, 4 cars, 5 cars, 6 cars. So let's say you started at age 30 and you went all the way with 6 cars, 5 years a car, all the way to age 60, okay? So if you start at age 30, went all the way to 60, that's 6 cars that you go through, that you burn through over that period of time. And what do? You'll notice right here, we have 0. This baseline, this line right here is the 0 line. You saved up 50,000, 1, 2, 3, 4, 5, 6 times, and at the end of the day, you spent that 50,000 down. And if you notice here, what happens is you started with 0 and you end with 0. Now here you end with 0 and you still have a car that's, depreciated over a 5-year period. But at the end of the day, you always have to be thinking about cash flow, right? We always talk about cash flow hacking, cash flow investing. Well, I utilize cash flow hacking because I believe buying appreciating assets and cash flow producing assets is one thing. It's the best way to go. But at the end of the day, when we're talking about cash flow hacking, we're always thinking about what does our cash flow look like? And we need to plan for cash flow. And so from this perspective, we're looking at, all right, we built it up for 5 years. We now have to think about, we're saving back up. We have that car, we're saving up for the next second car. This is $10K per year, $10,000 per year. So you always have $10,000 going out per year. Even if you don't have a car payment, you have to save for the next car. Otherwise, in year 3, if I said I'm gonna buy this car, I'm gonna buy this car right here, and then year 4 or car 4, that I'm not gonna save up while I'm driving car 3. I'm not gonna save up, for this 4th car. I'm just not gonna do it. What happens is this car is gonna be run down, and eventually I'm gonna have to go finance my next one, or I'm gonna have to keep driving this, into perpetuity. Maybe get 10, 15 years out of it, which is an option if things get really hard. So you're certainly better off than financing it. But at the end of the day, cash flow is what matters. And we're talking whether you're paying $10,000 a year in financing or whether you're paying $10,000 a year of savings, which is what you're doing here, then it's all about cash flow. You still have cash flow, $10,000 going out every single year. So this is what I want to do. I want to go over here. I want to compare now. Now that you understand that on the savings category here, we saved, we spent, we saved, we spent, we saved, we spent 6 times. We end at 0. We started at 0. At the end of the day, you are in good shape because every 5 years or so you've got this money saved up here, so you don't necessarily have to buy the car. You're in more control, and that's a good thing. But let's face it, most people don't do that. Like I said, what do most people do? Most people go here and they say, all right, I'm going to use the gold here again just to kind of give a contrast. Most people don't save money at all. They get out of school, they get a job, they start getting cash flow. Maybe they start making, $50K per year of income, right? And they say, you know what? I don't have the savings. I need to buy a nice car to look good for my friends. And so I'm going to finance it. And they go into debt. And so then, they go through 5 years, they finance it for 5 years, or if, unfortunately, maybe they finance it for 7 years at this point in time, paying more interest. So what happens here is that they're going to pay interest expense here, right? They're going to pay an interest expense above and beyond the cost of the car, and they're in debt the whole time. So if they lose their job at any point in time during this period, they're at more risk, right? But at the end of the day, whether you look at this and you say, all right, We're talking about the first car, second car, third, fourth, fifth, or sixth car. Like at the end of the day, yes, you are at higher risk whenever you first get the car, because if you lose the job, if you lose your cash flow that is paying back these loans at these point in time, then you are at risk. Because if you lose it at year 3, if you lose this cash flow and you don't have enough savings, if you haven't saved up money, in this spot, well, now you got to still pay for the car. They could repossess the car, you could lose everything, and there is absolutely more risk. Not to mention you're spending more on interest in a lot of situations. But at the end of the day, the key here is to understand is you're still ending up at zero. Whether you finance cars or whether you pay cash for them, you get to the end of the 30 years and you have nothing to show for it, because you've transferred all the money to the bank through this system, right? By financing, you've given all your money to the banks, and in the top system, you've basically taken all the opportunity costs. You've cost yourself the opportunity cost of giving up the cash and paying cash, because when you spend $1, not only do you lose that dollar, you lose the ability for that dollar to earn for you, right? So in this situation, 50,000, even at only a 4% return on 50K equals 2,000 per year, right? That's a big number. Like when you really think about it, that's when you compound that over time, this 2,000 per year over a 30-year time frame, if you did that as 120K, right? Think about that. So what if you could do something that gave you the best of both worlds, right? Where you didn't have to lose the opportunity cost to buy cash, and you didn't have to transfer all your money to a bank, for giving you the right to access that money ahead of time. Well, here's the bottom line. Here's what I want to tell you, actually, before I go into this. I'm going to tell you right now, you're never going to make your money back by buying cars. You're never going to get rich. You're never going to get wealthy by buying depreciating assets. All I want to say is that this is a system that I'm going to show you that doesn't focus on how to get rich buying depreciating assets, because that makes no sense to me. It just doesn't, because it's all about cash flow, and it's all about focusing on like, well, what are my options? I could buy depreciating assets, or I could go buy cash flowing assets. And my mindset is saying, all right, no matter what you're going to do, if you're going to buy the car anyway, do it the most efficient way possible, right? It's all about efficiency. So let's not transfer the money to the banks here. Let's just not do that. Let's go over here and let's implement the best of both worlds. So what are we talking about here? We're talking about not interrupting compounding. We're talking about saving money the first 5 years. Now, I know it looks a little bit different, but this would be like this. We'd be there, we'd be saving, we'd be saving, we'd be saving, and we'd be getting up there in like 5 years. So this is like year 5 right here, right? And so you saved up for 5 years, and you saved up the 50K, right? So this is combining the concept of leveraging a bank, but instead of leveraging a bank, and instead of saving your money in a savings account, which is what these guys do, this is the power of, instead of doing this, which would be a bank account, save in a whole life insurance policy. And this is what a whole life insurance policy would do for you. Because when you have your money in a whole life policy, you can save the money up and you have this 50K here, right? But then what happens is when you want to go buy that car, you get to borrow against it, and you take a loan against it, and rather than pay the bank back, you pay the insurance company back. But at the same time you're paying the insurance company back, your money right here continues to grow. It's growing on an uninterrupted basis, right? Now, you do have to manage your cash flow. You need to pay it back. You have a lot more flexibility and control over how you pay this back. If you did lose your job in the middle, if you lost your job in the middle right here, you have a little more ability to kind of kick the can down the road and have a little more grace to be able to make your car payments and not have your car repossessed and stuff like that. So you have more control as far as that goes. But the key here is, what I want to show you, what's really important to understand, is that within 2 cars, 3, 4, 5, 6, you'll notice nothing really changed. The only thing that changed is we didn't do get into debt right out of school, right? We didn't get out of debt and start, going into debt for the car right out of the gate. We did delay gratification and we saved, right? We delayed that gratification for this period of time and we saved right there. So you do have to implement saving tactics, but here's what I love about this concept. You're not getting wealthy buying cars. What you're doing is you're just increasing the financial efficiency. You're basically recapturing the money that you would be spending in interest to the bank, and you're taking all that interest that you would spend to the bank and you're creating a financial system that allows you to recapture it, right? And you're not recapturing it because you're paying yourself back, because here's the deal. If I'm paying the insurance company 5%, but I'm earning 5%, well, that's okay. A lot of people don't realize that. A lot of people like Dave Ramsey's of the world, like, why would I pay to borrow my own money? Well, you're not paying to borrow your own money. You're paying to borrow the insurance company's money right here to get the car. And now you're paying back the insurance company every single year. All the while, your money is sitting in this account growing at 5% per year, right here. Your money is sitting here growing at 5% per year. I'm going to use the gold because I need to see it closer. 5% per year. All the while you're making the payments back to the insurance company when you leverage it for the car loan in this situation. Your money never gets interrupted. That's the magic of where this happens. Now, here's what I love about this. When you look at this and you understand, this is what we call a wealth creator, right? When you look at this and you understand the concepts and the principles that I'm talking about here, whole life insurance policy is the only financial vehicle in the world that will accomplish this for you. It's not even debatable, right? And so when we look at this though, and we think about what are we doing, it's not the activity of buying the car that's creating wealth. It's the system and having control of that financial system and having a set of rules in that system that are changing everything. And what does that system mean? It means, well, rule number one, we're going to save money in this first period of time, right? Like, we're going to save this money. We're going to delay gratification. We're going to capitalize our account and have a long-term view. You don't solve long-term problems by implementing short-term thinking, right? That's a really important concept and principle to understand. And so we're going to save that money up there, and we're going to have that money. We're going to delay that gratification, and then but where we save is going to be more important. Rather than saving in a savings account, we're going to save in our whole life policy. Now, with that said, with this right here, remember, you have 50K at that point in time. You're going to be driving a beater this whole time. You're probably going to be looking forward to driving a better car at some point in time. So you're going to be geared up to go do that at year 5. But the bottom line is, what happens if something bad happens at this point in time? You've got your 50K emergency fund. You can take that and run with it as you want. Now, here's what I would encourage you is, and what I think is really important to understand is that it's not about going and buying the car. I think if you implement these principles, you're probably going to want to save more money. And what happens if the market gets really bad right here? What happens in year 5 if the market gets really nasty and opportunity around us happens, like unemployment goes up, mortgage rates or houses, foreclosures, all that stuff, like 2008 happens again, and opportunity opens up. Well, now you got 50K to go out and find opportunity. You could buy a cash flowing real estate property. So if you had the opportunity to go buy a house that you could cash flow or a car that will depreciate, which one would you choose? Well, I would say the house wins every single time. And I think most people right out of the gate, if you had this 50K liquid and you knew in a down environment right here, you could go buy a house, then you would buy a house. Because if we play this out and we said, all right, like, you saw what I just did there, right? And it goes up like this, and this depreciating asset never really gets above this white wealth curve, right? Because of the fact that, let's face it, it's a depreciating asset, so it's always going to be worth 0 at the end at some point in time. But what if instead of buying a depreciating asset, we combined the activity of saving in a whole life policy like this, and rather than buying depreciating assets, buying cash flowing assets, right? So now what's going to happen is instead of doing this, we go and we buy a cash flow asset instead of buying a car, and now the wealth curve goes up through the roof even higher, because on top of the growth of the wealth inside of the policy growing at, let's say, 4% per year, you have the actual asset going up in value as well. So what you see here is that it's not the activity of buying the car. You're not getting rich buying your cars. You're simply being more efficient buying a car you'd buy anyway, which will help you recapture some of the money you're paying a bank. But my encouragement to you is thinking about building the system first that will set in place a set of rules for you that will get you closer to your financial goals and objectives on a more predictable basis sooner. That's what this is all about. So when we talk about cash flow hacking and utilizing whole life insurance to do that, this is what I'm talking about. And that's why whenever anybody asks me, Chris, what do you do? I just tell them I'm a financial efficiency coach, because I care more about the fact, well, think about it this way. I want to show you this. Let's just do a little math right now, right? Because this is the problem with the financial world right now. Take a family earning $100,000 a year, right? The traditional financial advice is take 10% and save, right? So that's $10,000. And take 90% and you spend it on your life, right? And that's the bottom line. And this 90,000 that's left, you just blow on whatever, and that's your lifestyle. Now the idea is take this 10,000 and go try to chase like a 10% rate of return to be able to reach your financial goals. But the bottom line is, what if you go to get a 10% return on $10,000? What is that? That's $1,000 of interest, right? So you got to take a lot of risk to get this $1,000. Well, what if I looked at people that had $90,000? Well, if I asked you at $90,000, do you think you have 1% inefficiency in your life? Most people would say yes, right? So 1% inefficiency is $900 of return. So if I could show you a way that you could save $10,000 in a system like what we're talking about here, but as you're saving that $10,000, we also look at this $90,000 and we just try to increase your efficiency by maybe 2 or 3%, we can get you a bigger return with less risk. That, my friends, is how you create wealth on a predictable basis, and you take that wealth that you have, you save for emergency, and then you save for opportunity. You save with the intent of investing, and when you have the right capital to go out and invest in cash flowing assets, that's when you do it. You create a financial system that all your major expenses are flowed through to recapture the money that you'd be transferring to the banks throughout your life. And if you did the math on all the money you've ever given to banks, you probably vomit. It's disgusting, right? And so what we do is we teach people, I'm not promising you this is gonna be easy. Nothing worth doing in this life is easy, but I promise you it will be worth it if you just learn the principles. So if you have any questions, reach out, comment in the comment section below. Hopefully you found value in this video. I know it can kind of be a little bit complicated. I try to break it down, make it as simple as possible, but I do try to engage with every single comment. Once again, reach out to me, chris@life180.com if you have any questions. If you want to talk to somebody on my team, go down, schedule a clarity call, figure out how this could work in your life. We call it a clarity call because our goal is to help you have clarity about what this would look like in your specific life, how you can manage your debt, how you can manage all the assets that you want to purchase in your life, whether it's cars, whether it's real estate, whether it's a business capital reserve fund to make sure you're buying major capital purchases with your business. All of it comes into play. And if you could increase the efficiency with how you're handling and recapture the interest that you're giving to the banks from here until the rest of your life and your working days, think about the impact that would have in your retirement fund. Most people give way more money to banks in interest throughout their life than they ever save for their own retirement. Let's flip the script. Let's put you in control of your own money and in control of your own financial destiny. And when you do this, you can reach financial freedom much, much faster. That's the cash flow hacking way. So anyway, that's it. Have a blessed, inspirational day. We'll talk soon. See ya.